Welcome to the Balancing Act podcast with SingerLewak, where we're kicking off our new series, Building Blocks for Business Success. In today's episode, we're taking a closer look at the federal R&D Tax Credit and what business owners should know as they plan for the year ahead. Joining us for this conversation are Mike Mondelli, Director in SingerLewak's Tax Advisory Group, Tax Partner Eric Lake, Audit and Assurance Director Cecilia Sanudo, R&D Tax Credit Specialist and Tax Director Lydia Clowney. Together, they'll walk through the credits requirements, recent legislative changes, and practical considerations for taxpayers navigating R&D-related expenses in 2026.
Thanks for joining this SingerLewak podcast on building blocks for business success. This episode is maximizing R&D tax credits, tips, and strategies. And I'm joined today by Eric Lake and Cecilia Sanudo from our tax department and SingerLewak's R&D Tax Credit Specialist, Lydia Clowney. Lydia, why don't we start off with a little information for our listeners on what is the federal R&D tax credit?
Yes, and thank you so much for specifying federal. And I guess I'll go further and specify United States Federal R&D Tax Credit, which its real name is the Credit for Increasing Research Activities. This is, put very simply, one of the most valuable credits or incentives that the government offers to taxpayers. And it's available really to any taxpayer that is performing research and development activities, incurring research and experimental expenses within the United States. Now that's, again, perhaps a little bit too simple. This is United States tax code. So we have nested if-thens and caveats all the way down. And this isn't confined to any industry at all. The way the tests are written, it talks about the character of the activities and expenses themselves. So depending on circumstances, it really is open to anybody so long as they fit the criteria. The credit uses what we call a 4-part test to describe activities that qualify for the credit. We should be developing new or improving upon the quality, functionality, reliability, or performance of a product or a process or a software or a technique or an invention or a formula. If we're doing that, then that's a pretty good indication that there's something we should look at more closely. The other parts of the test are predicated on technical uncertainty and require that we be performing a process of experimentation in order to work through technical uncertainty. And of course, we always want to remember that research and development for the tax credit does need to be technological in nature. It needs to be predicated on the hard sciences, and that's defined as physical, biological, or computer sciences, or the principles of engineering.
And there's definitely been some changes with the One Big Beautiful Bill that was passed last year. But I think before we get to some of those changes, let me ask Cecilia and Eric, when you get questions from clients about R&D, what are they asking about? What do they know about it already? Or have they just heard about it and they want to find out what they can qualify for?
Thanks, Mike. We are hearing from a lot of business owners with regard to the recent changes to the Big Beautiful Bill and what the company's options are for taking advantage of the changes that recently came to place.
The OB3 last summer didn't make any real changes to the credit regime. And in fact, the Tax Cuts and Jobs Act that began requiring the capitalization of research and experimental expenses on the tax return also didn't make any real substantive changes to the tax credit. So this gets into a little bit of a different area. I've been working in R&D tax credit, the R&D tax credit space for a while, and we always used to tell people that this was a great opportunity because it's a double dip. You get to take a tax credit, which is a dollar-for-dollar reduction in your tax liability, and you also get to take your tax deduction on the same expenses. And there aren't so many areas that we get to do both of those things. You don't lose your deduction by qualifying the expense for the credit. The Tax Cuts and Jobs Act of 2017 really changed the game, and it's instituted a requirement to capitalize and amortize research and experimental expenses on the tax return, both foreign expenses as well as domestic expenses. And so while the capitalization is not permanent, you do get to take amortization deductions on these expenses. It means that it disconnected the deduction of these expenses from the year in which they were incurred. So taxpayers that are incurring these expenses could still take credit on them, but they weren't able to deduct the corresponding the expenses on their tax returns in that same year. Instead, they'd have to capitalize them and trickle out amortization deductions over 5 years for domestic expenses, or as much as 15 years for foreign expenses. And that was a huge change. So when we're talking about research and experimental expenses and deducting them or capitalizing them on the tax return, we're talking about expenses under our Internal Revenue Code section 174. I'm sorry, I'm cringing as I say that because I know I'm not supposed to throw code sections at you, but I do think it's important to specify that the definition of research and experimental expenses, again, for deducting, is really quite broad. We don't have there isn't a lot of specific guidance within the code to say what they are. And the only current guidance that we have is a notice that has since been kind of superseded. All this to say, there isn't one great definition of what these expenses are, and as such, it is taken to be very broad. On the other hand, the expenses that can be evaluated for potential inclusion within an R&D credit are very, very narrowly defined. So from a credit perspective, the only expenses that are eligible potentially are wages associated with employees performing qualified research. They are, and that's basically W-2 wages. It's wages taxable to the employee that are associated with qualified research. Tangible supplies used or consumed in development that aren't, depreciable equipment. Contract research, which is third-party contractors assisting with qualified development, and then also what we call computer rents and leases. In a more simplistic way, we could kind of just call that cloud hosting used in development. So really only four things. And if I think about, let's say, wages, for the credit, I can only include wages taxable to an employee. So let's say Box 1 W-2 wages. On the other hand, if I'm thinking about my employee expenses that I might associate with research and experimentation from the Section 174 deduction perspective, that would probably include not only wages, but also employee benefit, workers' compensation, payroll taxes. You can see the list might go on. And that's true when we look at the other types of expenses too. Software, for instance, is typically, you think of an off-the-shelf software used in your research. You think that might be a credit eligible expense. It's not. But it probably is a research and experimental expense from the perspective of, do I need to consider this for capitalization under that prior regime?
So it sounds like this is a really good time for clients to reevaluate their prior year R&D expenses and credits and see if maybe there's an opportunity.
The tax years 2024 and 2025 are hugely important as a transition from the Tax Cuts and Jobs Act rules and the OB3 rules. And I would say that they are really important years for any taxpayer that's incurring research and experimental expenses, whether or not you've ever taken the credit before. The OB3 passed last summer, summer 2025, and it included some really beneficial provisions for small business taxpayers to allow them to recoup their previously capitalized domestic research and experimental expenses, either with their 2024 return or via amending their 2022 and 2023 returns. So this is largely water under the bridge at this point, unless you're a fiscal year taxpayer and you still haven't filed your tax year 2024 return. If that's the case, you might still have these options available to you. And what they were is that the OB3 allowed, again, small business taxpayers to elect on the 2024 return immediate expensing of their 2024 research and experimental expenses, or I should specify their domestic research and experimental expenses. You could use one of two methods. You could either claim all of your remaining unamortized deductions from 2022 and 2023 together with your 2024 return. That was a huge windfall for a lot of taxpayers, big extra tax deduction. So there were some taxpayers for whom that wasn't helpful. Maybe they didn't have enough taxable income in 2024 to be able to absorb, all of those additional deductions. Those taxpayers were allowed to instead go back and amend 2022 and 2023 to claim the deductions in those years instead, essentially just unwind the capitalization and amortization that they had done in those years. And so for taxpayers that had paid tax in 22 and 23 because of those big book to tax adjustments, they could actually receive a refund for that. So again, not necessarily still an option for a calendar year taxpayer, but we do still have things to do on 2025 as well. And a big reason for this is because the OB3 did not rescind the Tax Cuts and Jobs Act requirement to capitalize and amortize exactly. What it did was write a new code section. So I might have mentioned code section 174, which talks about research and experimental expenses. And the OB3 wrote a new code section called 174 with a big capital letter A. 174 cap A is what we call it. And so all taxpayers incurring domestic research and experimental expenses should make an election on their 2025 return to choose a method of accounting on their tax return under 174A. Either they can choose to capitalize domestic research expenses, or they can choose to immediately expense domestic research expenses. So everyone, all taxpayers with research and experimental expenses will be making an election on their 2025 return. The question is, how are we going to make that election? For taxpayers that are already compliant with the Tax Cuts and Jobs Act requirement to capitalize and amortize, it's very, very easy, delightfully easy. All we have to do is file a statement in lieu of 3115. Basically, we just have to file a fairly straightforward statement with the tax return that explains that we are making this change. And that sets us up to be able to immediately deduct domestic research expenses in the year incurred for 2025 and for going forward as well. Unfortunately, for taxpayers that were not already complying with the Tax Cuts and Jobs Act requirement, so think a taxpayer that has research and experimental expenses and has not yet started capitalizing them for the tax return, maybe was trying to wait the rule out, thinking maybe it would go away. For those taxpayers, we can't use that simple tax return statement. Instead, we're forced into what we call an application for a change in accounting method. It's a little more onerous, but it's still something that we recommend doing in order to be able to set a company up to take advantage of immediate expensing on a go-forward basis.
And we have the tax experts here in our tax department to help file those forms and election statements and take care of everything to get our clients on the right path.
As we prepare as tax preparers and the partners of the tax prep group, that we're aware of that and will be taking that into account. And that's where people like you, Lydia, are going to be important. And, as a firm, we should allow you to be a part of our tax prep. Another question, and this is a question, Lydia, that one of our current clients that you are helping me with asked was, what are the R&D tax credit percentages?
That's a complicated question with a really simple answer. We have two different methods of computing an R&D tax or a federal R&D tax credit. They've got a lot of inputs. There's a look back period that differs depending on the credit calculation method. All that to say that a good rule of thumb is that a federal R&D credit is probably around 6 to 10 cents on the dollar for qualifying expenses. And that's
So 6
important
to
because
10%.
yeah, 6 or 10%, again, on qualifying expenses. And again, I'd want to highlight that those qualifying expenses are confined to domestic wages, supplies, cloud hosting, and third-party contractors assisting with development. And I will say, too, there are caveats even within those rules as well,
So
particularly for things like third-party contractors.
this is a good point for our clients to be talking with us about that, so that we can be as efficient as possible with these credits and include as much expense that we can that would qualify for a R&D tax credit.
Yeah, absolutely. I always recommend, if there's even an inkling that there might be some, experimentation going on at a company, that folks get in touch. It's typically pretty quick of a process to talk through whether a company has eligible activities and eligible expenses. But it can be a real slog to try to self-educate on that, because there are just a lot of caveats and pitfalls that you can encounter that might make what seems like a really promising credit actually kind of evaporate into nothing. And I'd say that just as often I see the flip side, a company that really doesn't think that they deserve the credit or should be eligible for the credit, maybe because they're not the kind of entity that does R&D as a matter of course or as a part of their normal business. And so they think that they're just not eligible, or that it's just not worth it. And we often see that those taxpayers really can derive a great benefit.
So what revenue levels do you think would qualify to make a R&D tax credit very beneficial?
Not every taxpayer has to have revenue or taxable income in order to benefit from a credit. So I'll say this first off, that there are some really beneficial provisions in the tax code for startups that are pre-revenue to still be able to claim a benefit from an R&D credit they generate. If a company has not had research expenses and income for more than 5 years, and they have revenues under $5 million a year, then they may be eligible to elect their credit to offset their payroll tax obligations instead of having to carry that credit forward, waiting around until they have an income tax liability. No one has to claim an R&D credit. So we understand if there isn't an ROI there's no requirement to do it. You're not going to pay someone to do a credit calculation or a study for you if it's not going to actually give you a benefit. When again, this is not a mandatory area of like tax compliance. It is very tough to give a bright line dollar value for what makes a credit calculation worthwhile. And part of that is because the work involved in actually getting the credit computed can vary so vastly from company to company, depending on how many qualified business components, or we'll say projects, a company is working on, can have a huge impact. The number of people involved or the number of contractors involved. Let me give you a really simple example. Sometimes we see an entity is paying one single third-party contractor to do a software development effort on their behalf. That is a very confined, contained, understandable item. In some ways, it's just a single expense line item. That's a very simple credit to compute, and it's a very simple credit to understand. So something like that, we might see the expense of $50,000, and you might be trying, thinking, oh, 6 to 10 cents on the dollar, 50,000, is it really worth it? The team's probably going to charge a bunch to compute it, and that math might not actually be relevant at all, because it might be very, very cheap to actually do the work, to evaluate, say, that one contract for qualification, and to put the form together. If there is an inkling that a company has these expenses, these activities, we really encourage them to get in touch, because, the credit is great and it's beneficial, and we'll really hope to help you claim it if it makes sense for your company. But there also is the compliance issue now with these research and experimental expenses. And so even if a company doesn't have enough expenses to make filing an R&D credit look super attractive, we might still be able to help simply from an understanding of the risks and a mitigation of the risks standpoint.
If I was going to give all of our clients one piece of advice here as they start the new year regarding R&D credits, it would be they should talk to their SingerLewak team about this topic. And if they're not already qualifying for an R&D credit on some of their projects, their process improvements or their product improvements, maybe there is an opportunity for them to qualify. And if they talk about it early in the year here, they may discover that, yeah, they do definitely have some things that qualify. And if they're talking about it early in the year, that might help us out when we get to the end of the year when it comes to documenting things for their expenses and getting them qualified for the credit. Which leads me to one last question I have for you, which is, what would best case documentation look like here when someone is trying to look at someone's tax records at the end of the year and determine what qualified for an R&D credit, who worked on it, what expenses were incurred, and which projects those people and expenses were tied to?
That's a tough question too, because that kind of documentation looks so different from entity to entity. Depending on what a company is actually doing or building or making, how many people are involved, those records might look really different. If a company has timekeeping records, that certainly can be a place to start from an evaluation standpoint or from a support standpoint. But timekeeping or time tracking is not at all required to file or claim an R&D credit. I'd say the majority of the time we end up using a sort of an interview approach, using evaluation of financial materials and layering in that conversations with technical people who are close to the development activities. And those are the people who tend to know who was working on what and what went really badly. That's usually a really fertile area for R&D credit, is when things are tough or are potentially failing. These kinds of calculations I really think of as a partnership between the taxpayer, and their R&D accountant, their R&D professional. We come with the understanding of the tax code and the rules and regulations, and we help layer that into each company's specific situation, and how do the rules actually apply to this very human situation where you have people on the ground actually making the garlic bread or coding the software or what have you.
Yeah, I've definitely seen some R&D studies where it was things like snowplow attachments for farm implements, or we service water towers and other large complex buildings, and we have to get all of our equipment out in the field. So we've redone the process of how we put everything on the trailer.
Every time I go to a metal stamper, it makes me see the world in a different way. I'll start looking at just, a door handle attachment, you push to exit, and I can see that part, that part. They had a really hard time with that part. They were having some, It really makes you see sort of all the different bits and bobs that go into making our world what it is, and start thinking about how much effort and time people had to put into figuring out how to do it. And that's what we're here for, is get you some money back for that.
Great. Thank you, Lydia. Thank you, Cecilia. And thank you, Eric. And for all your questions regarding R&D tax credits and everything else tax and assurance related, contact your SingerLewak tax professional or assurance professional.
Thank you for joining us for this episode of The Balancing Act. If you have any questions about R&D tax credits, research and experimental expense rules, or how recent tax changes may affect your business, connect with a SingerLewak tax or assurance professional. Our team is here to help you evaluate your options and determine the best approach for your organization. Be sure to follow SingerLewak for future episodes in our Building Blocks for Business Success series, where we continue exploring topics that support your business growth throughout the year.